So ladies and gentlemen, now to shed light on the future of Indian equity markets, we are privileged to have with us our esteemed panelists. To start with, guiding our exploration of Indian equity markets, please welcome our adept moderator, Mr. Govindraj Ethiraj, journalist and founder of The Core. Mr. Ethiraj is a seasoned Indian journalist with over 25 years of experiences in business reporting. As a media executive and entrepreneur, he founded The Core, a business news website, newsletter, and podcast. Mr. Ethiraj is also the founder of Boom, an initiative combating misinformation, and India's Pen, a public interest journalism outfit. He played a key role in establishing Bloomberg TV India and has received recognition for his leadership in media and fact-checking, including the 2018 McNulty Prize. So welcome our moderator, Mr. Govindraj Ethiraj, on stage, please. Now join me in welcoming our esteemed panelists as well. We have with us Mr. Sanjay Chawla, CIO, Equity, Baroda BNP Paribas AMC. Mr. Chawla brings over 33 years of expertise in fund management and equity research. Formerly CIO at Baroda Asset Management, he held key roles at the Birla Sun Life AMC, SBI Capital Markets, Motilal Oswal Securities, and more. Mr. Chawla oversees equity investment, fund management, equity research, and team governance, managing schemes for the mutual fund. Can we please have Mr. Chawla join us? Next, we have Mr. Gautam Duggad, Head of Researcher, Director, Institutional Equities, Motilal Oswal Financial Services Limited. Mr. Duggad joined Motilal Oswal in 2012 as a consumer analyst, and in December 2015, he was elevated as Head of Research, Institutional Equities. Mr. Duggad also dons the hat of a strategist and an FMGC specialist. He started his career as a key account manager at P&G, post which he moved to the equity research. He has over 13 years of experiences in Indian equities. At Motilal Oswal Securities, he spearheads a team of 40 analysts covering 17 sectors and 220 plus stocks. Let's welcome Mr. Duggad on stage, please. We have again joining Mr. Mahesh Nandurkar, Managing Director and Head of Research, Jefferies India Private Limited. Mr. Nandurkar has 25 years of experience in Indian equity capital markets. He has spent 18 plus years with CLSA in India as their Head of Strategy and Thematic Research. His views are regularly carried by the print and the electronic media and has been a key opinion maker for institutional investors. He is also a member of the CII Committee on Financial Markets and worked very closely with Ministry of Finance, Ministry of Commerce, etc. on policy issues. Let's welcome Mr. Mahesh Nandurkar amongst us. So this is going to be a panel session that is being moderated by Mr. Ethiraj. Please enjoy it.
Thank you. Check 1, 2. Yeah. Thank you, Baroda BNP for Paribas for inviting me. So the objective of this discussion is to essentially understand where the markets are going and where they are presently. It's always a great day to talk about markets when the Sensex is 1,000 points down, because then you're thinking of an upside and not struggling to figure out which way things could go. So the only way is up, as some people would say. So the structure is going to be like this. I'm going to ask each of our speakers to speak for a few minutes each, just to position things as they see. The theme is Outlook 2024, as you know. And I'll also urge two of our panelists, that's Gautam and Mahesh, to bring in an additional perspective born out of their travels and their recent travels. So their own perspective on how they see things right now, maybe blended a little bit with what investors and big investors outside India are telling them from the west and the east, as it were. And we'll use that as a basis to then have a conversation on either sectors or what's really going to be driving capital markets. The background is quite simple. I think we've covered a lot of this already. The tailwinds are strong. There is macroeconomic stability, there's political continuity, the inflation targeting and levels seem to be under control. Forex is moving in a band which is again predictable. There are some unpredictables, but that's beyond the scope of this conversation at least. So that's really the background. So with all of this, where could it go in 2024? What could drive it further up? And obviously we must, in any such discussion, talk a little bit about risk factors as well, because there are always risk factors, some within our control and some not. So on that note, let me start with you, Mahesh. So a few minutes, take us through how you're seeing the outlook in general, blended with your recent travels.
Thank you, Govind, and thank you for having me. So many thanks to BNP Paribas for hosting me. So we start the year, at Jefferies start the year, 2024 on an optimistic note. We clearly mindful of the fact that the last couple of years have been very strong for the Indian equity markets in general, and we are sitting as Neelkant, the previous sort of speakers spoke about in terms of the valuation. But we continue to believe that the current market multiples that we are seeing right now, though elevated, there is a reason why it could sustain over a period of time, and we believe that the equity markets would broadly deliver returns in line with the EPS growth, the earnings growth, which we believe is going to be in the range of 12 to 13%. So clearly not as ecstatic a return as we've seen over the last couple of years, but definitely still in the positive territory. Now clearly the underlying assumption here is that the global liquidity environment, the domestic factors continue to be supportive. I don't really see any big reason why it should change. Our basic thesis here is that as the US Fed begins to starts the rate cut cycle, and the current market expectations are somewhere between 125, 150 basis point of rate cut this year and maybe more going forward. We believe that the US dollar, which has been an extremely strong currency over the last 2 years, will begin to weaken, and that actually is an ideal environment for emerging markets to receive flows. So emerging market as an asset class should be doing much better in that environment, and India will receive its own share of flows, maybe a little bit higher than fair share because of the recent global sort of geopolitical changes that we've been seeing, and what we are seeing, which is the lack of investor interest in some of the other larger markets like China. So that clearly is one of the key factors to keep in mind. Secondly, we continue to believe that the domestic flows environment should also remain optimistic, and clearly the reason is that our analysis shows that at this point in time only like less than 5% of the total household assets are in equities, whereas that number has been much higher in many other emerging markets, in the range of 8 to 10%. The developed market, that number is much higher in like 20-25% or more than that. So we believe that the current level of equity flows that we're seeing from the domestic investors, while appears to be strong, can definitely sustain, because at an overall level, as a percentage of total savings or a percentage of household balance sheet size, it's still a small number. So with that, as the backdrop, we believe that the economic growth is will be driven more by the investment cycle going forward. Over the last 10 years, we've seen a big down cycle on the investment activities, but we are seeing the re-emergence of the housing market. I am a firm believer that the private capex should also start to show signs of picking up, and that's the reason why we believe that the overall economic growth and the corporate earnings growth should hold quite steady. Obviously, this is very different environment from what we've seen over the last 10 years, which was the period of, I would say, big risk aversion in the domestic economy, and therefore the stocks and the sectors that performed well over the last 10 years were very different from what it will be over the next 10 years, because the risk appetite in the economy has changed, and maybe we'll touch upon all those things as we go forward. But yeah, but I kind of definitely sort of want to end my preliminary thoughts on this outlook that yeah, we are looking at constructive returns from equity markets going forward.
And you've just come back from Davos. So what happened there?
Yeah. Yeah, it's been sort of quite a topical discussion. So Davos, as you all know, all the global leaders, come in, at a point in time. Although I personally believe that Davos is actually, just a small village, if you'll ask me, and it really kind of bursts at the seam, because we don't really have enough number of sort of hotels, not enough infrastructure in my view. But anyway, I'll not touch upon all those things. But what I'll definitely say is that the two of the very sort of common topics that were discussed there, one is the green energy transition, and secondly AI. That was, those two topics were on everybody's mind. But I would also like to add that India itself had a pretty strong and significant presence, at Davos. We had, 3 or 4 lounges of the government of India. There were several state governments showcasing the opportunities in those respective states for investment opportunities. We had several Indian companies, mostly the IT companies, showcasing, as well. So we could clearly see that Indian contingent was very strong. A lot of global speakers talking about India, in a very positive way. In fact, my personal interactions, with the CEOs of large global asset managers makes me believe that while India has not been on the radar screen of a lot of global mandates or global funds, so to speak, but I think increasingly it is looking up on the radar screen of many global mandates. I'm not talking about Asian mandates or EM mandates. They do invest in India because they are in a way forced to as well. But global mandates don't have any such compulsion to invest. But my interactions suggest that India is now showing up on the radar screens of many such global investors as well. So yes, I would definitely say that I'm coming back with a more optimistic view from there as
Gautam,
well.
I'll just come to you. But is that a shift in let's say the global pools looking at India versus, let's say, dedicated pools? I mean, or has this been happening gradually?
Yeah, so, as Neelkant also mentioned, at this point in time, the large part, of foreign money that's there in India is, mostly, through the India dedicated funds or India allocation coming from Asian funds and emerging market funds, and also the sovereign wealth funds and some of the, government backed funds as well. We have not really seen too many of the global mandates because for a global fund, most of the investors follow MSCI Global as the benchmark, where Indian neutral weight is just about 1.5, 1.6%. So it's a very small market which they can very easily ignore. But what I'll say is that it's a market now at an absolute basis is now almost like $4.5 trillion. We are now the 4th largest stock market globally by market cap. We are going to be the 3rd largest economy in GDP terms in a few years' time. So it is clearly showing up, I would say, on the radar screen of a lot of investors.
Right. Okay. Gautam.
Hi, good evening everyone. Thanks Govind and thanks the BOP team for inviting me. So like Mahesh mentioned, India last few years, if you look at Indian market evolution, India has very subconsciously become the cynosure of all eyes. Before we come to the short-term outlook, if you just go back 3-4 years, we've lived in an era from 2010 to 20 where corporate earnings had become a joke. People used to make fun of India's corporate earnings forecast. So the entire decade we've broadly grown at 6.5% earnings. In last 4 years, because all of us have got accustomed to seeing index levels, and media also makes a lot of song and dance about, no offense meant to any media outlet if it's present here. But you keep hearing this news that, markets at a new high, index at this level, that level. Very rarely have we seen a news item which says corporate earnings are at a new high. 4 years back, if I look at our own set of companies that we track today, that's about 270, 2020, that is right at the onset of COVID. The total profit pool that our coverage companies used to have was 4 lakh crores, so 4 trillion rupees. today, as we are about to end FY24, in 4 years, we've reached a profit pool of almost 10.6, 10.7 trillion rupees. So while index has gone up, the good thing in the last 4 or 5 years has been that the corporate earnings have followed through. Which is why, while everyone talks a lot about valuations, and of course they are rich, but one of the comforting factors is it's backed by a very strong and resilient corporate earnings cycle. The previous speaker in the economic session, Nilkan, spoke about deleveraging. The corporate balance sheets are in the best of their health in a decade. The net debt to equity ratio, if you look at the BSE 500 companies, is I think at its lowest in 10, 11 years. The hype which has got created in the last 8, 10 months, I think it's more to do with some segments of the market which has flown. But broadly, if you look at it on a slightly medium to long-term basis, we have crossed a hump in 2020. Second, while not necessarily linked to equity markets, I think the markets have become far more democratized today. You know, March 20, the total number of demat accounts in India were 3.5 crore. March 24 is yet to approach. We've crossed 14 crores in December 23. In fact, we are adding 40 lakh demat accounts per month. So clearly the weight of the market movement, which used to singularly depend on one particular set of flows, has changed in how. CY22, if you go back a year and a half, we had seen around, I think, $17 billion of outflows from FIs. 2008, similar sort of quantum of outflows had pulled the markets down by 30-40%, or maybe 52%, I think, if I remember my numbers correctly, Sensex. Because that point of time, you just had one particular flow of money which used to drive the markets. CY22, despite such a big quantum, of course, one can debate what is it as a percentage of market cap and all, but such a big outflow of capital hasn't dented the market. We remain broadly flattish. So to answer this question on outlook, I think this is going to be a very interesting year. It's going to be a very topsy-turvy year because this year is going to be led by events. In 2-3 months' time, you're heading into one of the largest political events of this decade, which is the general elections. While the history has been very clear, last 5 elections, 6 months into the announcement of election results from November to May, markets always given positive returns. We are broadly following that cycle. It's hazardous to make a short-term guess. But when you have such a big event driving the year, it's but natural to expect a lot of volatility. But as far as medium to long term is concerned, Mahesh mentioned about the investment cycle. I don't think anybody sitting in this room would have any doubt on where corporate investment cycle is headed today. And as far as valuations are concerned, because this is something which is attracting a lot of attention over the last 5-6 months, given the way some of the indices in India have done. I think you have to break down the markets into different buckets when you look at valuations. When I was just looking at some data points, Nifty is at about 20 times. One can debate whether it's the premium. If you look at 10-year average, it's bang in line with 10-year average. But given where rates are headed, cost of capital is higher. So ideally, the equity multiples should be slightly lower. But when you are headed into such a big flow of money which is coming in from a domestic pool of savers, fundamentals can sometimes get distorted. Right? Eventually they converge. 10 years when earnings grew at 6.5%, market gave you 8.4% compounding, underperformed gold. Last 4 years, broadly, market returns have tracked the underlying corporate earnings. If you look at the exact 5-year CAGR of earnings, Nifty is given about 15.5 or somewhere around that. And Nifty EPS is also compounded about 15%. Our team expects next 2 years earnings compounding at about 14.5 to 15%. So even if you are a very conservative sort of an investor, broadly market should track the underlying earnings cycle, given that we are headed also into a phase where rates can come down a bit. Quantum of rate cuts one can debate, but the direction broadly everyone is clear about.
And Gautam, you two have come back after meeting lots of investors. What are they telling you and balancing the domestic and the global?
So it's quite natural to expect the level of interest in India to be very high, given that we've been performing very well in the last 3-4 years. One distinguished feature I noticed about my meetings, whether it's Asia or US or Europe, there's very little discussion now between India and China. And in my short career of doing this road shows or marketing trips for last 12 years, I've noticed that in the earlier 7-8 years, almost, let's say if I'm meeting 100 funds, 30-35 funds would always discuss a lot on what is happening in China versus India, especially valuations, a lot of other risks. Last 1.5 years, I'm realizing there is hardly any mention of China, at least in my meeting discussions. It straight away boils down to stock ideas, sector views, because nobody is debating, whether to invest in India or not. It's a question of what you want to invest in India. So clearly, this also brings a lot of risk forward because markets have done well, earnings have done well, everyone is bullish, sentiment is positive, money is coming from all conduits, and that usually makes for a perfect case if you're a risk-averse investor to sort of bring the gears down.
So since you mentioned it, and I'm coming to you, Sanjay, after this in a second, what's the question that people ask or would have asked, let's say, in your meetings with investors, which in some ways you want to transmit to people who are running companies?
So see, first question, obviously, 6 months back, a lot of people expected elections to play a huge uncertainty kind of a role. Post 3rd of December, I think a lot of those fears have got abated. But elections are always difficult to predict. But at least I can notice that the concerns and fears around political uncertainty have died down considerably. Now the question is where to invest, because most of the sectors have done well. If you had asked the same question a year back and you looked at the spectrum of the sectors where potentially the valuations have a headroom and you would have gone and invested there, 12 months later you would have still felt that that was not a very prudent or a wise decision. And that is what market cycles make you do. In a bull market cycle, typically if you've seen, and you go back to 2003 to 8 cycle, 1997 till 2003, I think Sensex had done pretty much nothing. We were hovering around that 3,000 mark. The moment cycle started somewhere around 2003 to 4, I think FY04 was the first year of 8% GDP growth, that cycle. And earnings started compounding. People sold out in 2 years because a lot of stocks they've been holding doubled, tripled, quadrupled in 2 years. Only to see them quadrupling again from where they sold from 2005 or 6 to 2008. So we are, while no two cycles are exactly comparable, but broadly if you see some of the stocks, some of the sectors last 2-3 years, the market cap have compounded like in multiples. So that is one question uppermost in the minds of investors. How much more to go? Should we sell? Should we wait? Should we stay on the sidelines? And then, of course, you have gone through a period of 2.5 years of a rural consumption slowdown. So that is a topic which comes quite frequently. Because consumption, typically in India, it's a consumption-based economy. Your 55 to 60% of the GDP is PFC. And rural consumption dominates a lot of airtime in any discussion around consumption. So these are two broad questions apart from the usual on valuations, right, politics, and crude
and we'll talk about rural and consumption, consumer product consumption in a bit. Sanjay, so you're obviously benefiting from a lot of flows. So we've talked broadly somewhat on the demand side. So tell us about how life is on the supply side when it comes to managing flows and managing funds.
So I think last couple of years, the biggest thing that we've seen is on the earnings side, where the earnings have actually grown at a double digit. And this is probably one of the few emerging market countries where earnings have continued to report robust earnings growth. And do I believe that this would continue going forward? I think the next decade also holds promise. The math is very simple out there. So if you expect the GDP to grow at about 6 to 7%, with an annual inflation of about 4%, you end up with a nominal GDP growth of about 10 to 11%. Given the historical correlation between corporate profit earnings growth and the nominal GDP growth, it should not be difficult to see the corporate earnings to grow somewhere in early teens or mid-teens, assuming that the valuation sustain. This is what Mahesh had also indicated in terms of return expectation. That's where we end up with. Another question that keeps coming up is, look, India versus China, or India is trading at a significant premium to the emerging market. If you notice in the MSCI emerging market, China is a very big component out there. And in the last 3 years, China has got derated significantly. So if you look at India's valuation versus the emerging market ex-China, the valuations are really not that expensive. And typically when we are looking at India's valuation, you need to consider maybe 2 or 3 factors, whether it's the earnings growth, which is obviously there, we just spoke about. Another factor is in terms of the return ratios. If you look at the ROEs of the country or the index, post GFC, the ROE of the index kept on falling down, and it hit a bottom somewhere near COVID time. Post that, I think there's been a significant change in the capital allocation, and the ROE for the country as a whole has started improving. And third factor is, of course, when we look at global investors, they keep talking about, what's the market like? Well, Mahesh did mention that in MSCI global market, it's about 1.5%. But if you look at the emerging market as a basket, you look at the depth of the market per se, India has probably become a very large economy. In terms of market capitalization, till yesterday it was the 5th largest. Today it's overtaken Hong Kong. It's a large market out there. There are about 450 stocks which are in the investment radar of the FIs because they are more than $1 billion market capitalization. So from an emerging market perspective, I think it's a significant breadth of companies that we offer, both in terms of numbers and in terms of the sector diversity. And finally, people keep talking about India as an expensive market. Yes, I agree. Compared to the 10-year history, we are at the median. But you need to appreciate in the last 10 years, the entire dynamics of the country has changed. The characteristic of the economy has changed. We've become the 5th largest economy, and we're probably growing and probably becoming the 3rd largest in the near future. So that's an interesting dynamic that we need to look at.
So tell us about flows, as in you're raising money from investors as a mutual fund. How are you seeing flows in 2024 in light of all of what you've said?
So I think 2024, we have all the participants out here who can actually help us decide that. But, in general, if I look at the broader trend that we've seen in terms of the flows, it's been a pretty resilient flow. I mean, there have been policies which have unexpectedly led to significant flows into the mutual fund. And I can go back right to Demon, where all the money came into the banking system. We had the GST, which led to formalization of the workers, and again, the monies flowed through. Another factor is, of course, in terms of the inflation coming down, and because the inflation has fallen, your interest rates have fallen. So the alternatives which are available for the investors to invest in, I think equity really stands out there. So I think that continues to be a very strong factor. One trend that I've actually seen of late is the maturity of the investors per se who are coming into the market. They're really not looking at investing for short term. While the overall age of the investors come down, I think the maturity of the investors is very nice, in the sense that they understand that equity is a risky asset, it is a long-term product, and they're also looking at goal-based investing. Finally, I think something which is not really acknowledged too much is, the distribution community as such, in the last couple of years have led a campaign of educating the investors in terms of long-term investing, and that has gone down well. And that has actually brought in a lot of confidence in the retail investors that mutual fund sahi mein sahi hai. And I think that trend continues for me.
Got it. Okay. So, Mahesh made a point about the percentage of, assets that you put into mutual funds. I mean, in the context of overall financial assets. Now, this is a journey, obviously. I mean, we'll reach 20% maybe I don't know at what point. But what's your sense, Sanjay, just to come back to you? I mean, if you were to say 2024 would see the continuation of that journey, where do you think we could land?
Very difficult question to pinpoint an answer on that one.
But okay, so would you have a target? I mean, do you think there's a target? I can ask Mahesh that since he volunteered those data points. Go ahead, Mahesh. Why don't you?
Yeah, that 5% number becoming 20%. I mean,
No, that's a long way off. Okay.
yeah, that's a yeah. If it were to happen, I don't know where the index levels would be. I can't even imagine.
But okay, let me rephrase that. Let me say, so this is a journey. So how do you see this journey continuing in 2024?
Yeah, no, I definitely see, as you rightly mentioned, it's a long-term journey, and I'm just to give some specific numbers at a gross level. So in fact, this is something a point that I make to a lot of foreign investors as well. That while India might be a low-income country, but it's a high savings country, and at a gross level, Indian households save as much as, in fact, they say maybe 750 to maybe $800 billion at the gross level. And the kind of flows that we are seeing coming into equity markets, which is a combination of through the insurance policies, through the mutual fund and through the direct stock investment, is maybe about $40 to $50 billion. So even from a flows perspective, not the stock perspective, just from the flow perspective, it's just about 5% or so of the flows, of the annual savings. So I clearly see that this number, can it be like 6, 7, 8, 10%? It can be. And we have several examples in other emerging markets, let alone the developed world market. So even in CY24, I clearly believe that, unless there were to be like a big shock, so what we have seen, as the behavior of retail investors in the past is that for small dips, we have seen actually the retail flow increases, unless there were to be like a big correction like what we saw in March 2020, which was a COVID-led correction. And then for the next 9 months, we saw the domestic investors showing negative flows into the market. So if something like that happens, who knows? But otherwise, I do continue to see a continuation of the trend that we've seen last year.
Cool. Okay, so let me come back to you, Mahesh. So let's look at CapEx overall, since we're now trying to understand very quickly what is the constituent for, let's say, corporate growth or earnings growth, which in turn will drive markets, as I think we all agree now. So if you were to look at CapEx for the industry, I think there was a chart that we were looking at earlier from Neelkant, which said that basically we've spent the last decade almost only trying to catch up with capacity, and now we're peaking out. So what does that mean? I mean, does it mean that companies will now leverage once again? Does it mean that there will be more growth opportunities in companies for stocks?
Yeah, I definitely believe so. So what has happened in the most part of last 10 years is that there was hardly any capacity creation, and we just consume the capacities that we created, say between 2005 to 2012-13, or so. And what that was a function of was that last 10 years we saw variety of things, starting with the bankruptcy law, the GST, the DeMon, the RERA, the NBFC crisis, and so on. So that was also a period of extreme, I would say, risk aversion in the economy, as a whole, and the same was reflected in the markets as well. That even the stock market investors, had seen so many real estate, infra, power, some cement, and some steel companies went bankrupt. So that segment of the stock market was considered to be like a no-go, right? And the investors were saying that just don't talk to me about these stocks. So just tell me, the stocks which I can buy and, sleep peacefully at night. And even if it means whatever crazy multiples, I'm willing to pay for it. And that's what happened. And that was the right strategy, because that strategy paid off very nicely in the last 10 years. And in fact, I can share this personal experience because back in 2010, I was the consumer sector analyst. And when I used to pitch, certain FMCG stocks at 20 times P multiple, people used to say that 20 times P multiple for a company that's growing its earnings by 12-13%, it's too expensive. I can't buy. The same 20p stock then became 30, 40, 50, 60, 70, and the EPS growth did not change. For the same EPS growth, the market was willing to pay higher and higher multiple because of the risk aversion, I would say, in the in the investment side of the economy. But that has now changed, and I definitely believe that now some of those multiples will be retraced backwards. May not be to the same 20p level, but much lower than where they are today. But on the other hand, the capex cycle where we have seen, a big emergence, and some would argue that, some stocks have got re-rated already. But I would say that this is just the beginning, in my view, as far as the capex side, of the economy
the
goes.
capex cycle, if we are assuming that it is now on the verge of taking off again, is a trigger for growth? Is my question.
Yeah, no, absolutely. It is definitely a trigger for growth because you need investments for long-term growth visibility, because you can consume only so much.
So markets would like it, is what I'm saying. Is that when a company says, okay, I'm going to expand my capacity from X tons to Y tons, therefore I see it as good news of growth and capacity, and therefore would invest in it. Is my question.
Absolutely. Yeah. I'm in complete agreement with what you said.
Okay, got it. Okay, let me come back to you, Gautam. So let's look at consumer products for a few minutes. So the story now everyone knows is that there is a problem on the rural side, there is a problem on low value items, premium products are going. There was, I think, a question to that effect earlier as well just now. So give us a sense on how you are seeing it, and obviously I know your lens is very sharp, which is a good thing. You're saying that, okay, what is the stock that I can buy rather than what's the problem that the sector is facing? Go ahead.
No, see, we've overhyped consumption, at least in the stock markets. The reason I say that is if you look at numbers and you look at the trailing data, because future is always rosy for every stock in India. If you look at the trailing 10-year data in Indian consumption, and I'm talking about staples, FMCG, low ticket products, there are hardly two companies which have grown their top line at 10% plus compounding. I'm not talking about volumes, I'm talking about top line. So that includes volume plus pricing, right? And for that, obviously, we've also gone through a period where GST was implemented, lot of cost efficiencies were derived out of it, which were not fully passed on to customers. And then you also had a period which coincided with premiumization, which automatically lifted your realization and helped your bottom line. So even then, the compounded earnings for staple companies on a 10-year basis is hardly 12-13%. Now that 12-13% was getting 60, 70, as Mahesh mentioned, multiples. You have a similar sector, Indian IT sector. It has also grown earnings at a similar rate, 10-12%. Top line might be 1% or 2% lower because their sizes are very high now, at least the tier 1 IT companies. But when you discuss IT companies in India, moment their PE crosses 20, 21, 22, people start trembling. Right? Whereas for consumer stock, 50, 60 is par for the course, because people believe that the visibility of an Indian consumer using a soap or a shampoo for 50 years is there. Now, one thing you have to notice is in last 15 years, the penetration levels of a lot of categories have gone up significantly. And my own thesis is that once your category crosses 80-85% penetration, it's practically dead from a growth point of view. There are many such examples. You have detergent, soaps, toothpaste, n number of categories where penetration used to be 60-70% in 2005 to 10 era. Different categories crossed that 90% barrier. Some have even reached 95-100 also. The moment they cross that barrier, the growth slows down dramatically.
So when you say 95-100, is it percentage of population?
So it's very funnily defined in India. If you use a soap once in 6 months, you're a penetrated customer, right?
So everyone's trying to imagine what that smells like.
I used to look at this data very carefully when I was in my first job as a sales guy in P&G. So I, out of curiosity, asked the Nielsen fellows that point of time. So that's how they explain. But be that as it may, as long as you are making the same error for every category, you are comparing like to like. So your penetrations have gone up. That has killed the growth. At some point of time, growth will obviously come back because rural tend to be more cyclical in nature. The second element is some of this blame also rests with the companies themselves, because I think our companies haven't innovated enough in the last 10-15 years. 20-25% margins, 70-80% ROEs, everyone has become entitled to that. So when you get used to those kind of margins and return ratios, you take eyes off the innovation gear. And that comes to haunt you a few years later. So I think our sector sector is passing through that phase. But definition of consumption has evolved. 15 years back when we were tracking consumption sector, it used to be 14, 15 stocks, 10 FMCG stocks, 3, 4 retail stocks, and maybe some paint or some liquor stocks here or there. Today you are in a situation where staples has receded into a background and a whole new ocean of discretionary consumption has evolved. You have lifestyle, retail, jeweler, hotel, QSR, paints, like 10 subcategories. And today, I want 5 consumption analysts in my team. I have just 1. Because the traditional way of looking at consumption has changed in India. And as your per capita grows from 2,500 to 4,000 or 5,000, whenever it happens, obviously the incremental dollars, people are not going to buy more soaps or shampoos. People will splurge on some of the more discretionary items. Maybe you can include auto also in that, property also in that. Right? So the definition of consumption has evolved. You are seeing more new listings there. That itself necessitates more resources devoted to that space.
So when you spot stocks, and I'm going to come back to Mahesh in a second, when you look at stocks, do you look at companies who have a greater share or growing share of premiumization, or are you looking at companies which are pure premium products or services?
So there is no specific rule that at least I follow. I look at anything which can make me money, right? So because there's no price in following a particular style.
Yeah.
Ultimately, the color of the money is same, whichever style you follow. I think in consumption, you have to look at the size of the price, right? If you're present in a bigger category, and that category, if it's also growing, then obviously you're a larger size of a growing category. The second most important thing is that do you have a leadership position in that category? There are some companies which have been enjoying monopoly status in India for 5 decades. Right? And they've been able to protect that citadel from competitive attacks for a very long period of time. So by virtue of that, they tend to enjoy a lot more premium despite the growth being slow. Right? So you have to identify first the category size. Is that category growing? And within that category, if you have a demonstrated track record of gaining share and growing ahead of the category, it all sounds very cliche, but over a period of time, if you're able to practice that consistently, you wouldn't have done too badly.
So what's an interesting, so it's an interesting point that, you're saying the very basket of consumption stocks has grown quite dramatically, and in areas that we may not have thought of even a decade ago or a little more than that. What's an interesting consumption, let's say, industry or sector that you perhaps would not have thought of 10 years ago? This is only to think that when we look ahead, how we can think, more expansively.
I would think it's jewelry, right? Obviously with all disclosure in place, the sector which we have liked for almost more than a decade now. Today you have 10 jewelry companies listed. 15 years back, or maybe very early into 2000, the only listed jewelry player was making losses. Size of the category itself is $80–85 billion, depending on which publication you read. And Indians obviously have a great affinity for gold. We consume around 700–800 tons of gold every annum. Out of that, 60% is wedding jewelry. And if we all talk a lot about demographics, youthful demographics, that youth will at some point of time get married. So that gold consumption to me in India looks like a relatively more stable and consistent category where people have created a lot of wealth over a period of time. Obviously there have been many accidents too. So that's where you have to keep an eye on. Then of course there are a lot of new sectors which were hitherto not even listed. Footwear was as a category completely absent 10 years back. QSR started evolving post 2011 and today you have a situation where there are analysts covering only QSR sectors. So
and you were saying hospitals is another, not consumption, but
hospitality, hotels, I mentioned hotels, but hospital, you can't call hospital as a consumption, but yeah, even hospitals, you have 12 hospitals listed today. 10 years back, you had 2 hospitals. Today, you have a hospital company in the Nifty. Today, we actually, currently as I speak, I have a separate hospitals analyst covering only hospital stock in the pharma team. So, the complexion of the market changes because you're now a $4.4 or $4.3 trillion market cap. And as you evolve towards $6–7 trillion market cap economy and market cap at some point of time, you will have 10 more sectors which we today are not aware, which will be listed and will have sizable market cap and would have created tremendous wealth over a period of time.
Right. Okay, I'm going to come to questions in a minute or so. Mahesh, before we go there, you said that the sectors that you would have seen in the previous decade versus the sectors that you would look at the next decade, which I'm assuming is now or thereabouts. Tell us about what they could be and how they could be different.
Yeah, so when we talk about capex or investment cycle, I'm taking into account a slightly broader definition, which includes private capex and private investments, and which includes real estate as well. Because if you look at the overall investments in the economy, or we call as like GFCF, the gross fixed capital formation, almost 40% of GFCF is in the household sector. So I would definitely say housing and real estate still is a very, very attractive sector. I would say we are in the third year of the upcycle. Usually the real estate or the housing sector upcycle goes on for like 7-8 years. This time, my personal expectation is that it could be longer than that, so it could be like 10 years plus. And the reason is I see a very mature behavior from both the buyers and the developers and the sellers as well. So the whole segment, which is like housing related, and there are a lot of like derived plays in the building material segment as well. So in fact, just to add on to what Gautam said, in fact, and since you asked that question, which is the sector that you were quite surprised with. In fact, I would say that I was actually quite surprised when I met one of the sort of local fund managers that who covers cable sector in your firm, and I just thought for a moment, cables has now become a sector. Wow, so. And we have really seen, emergence of many of these building material becoming reasonably large sectors, or at least subsectors by themselves. So I think all those subsectors which are related to housing, building material, I think should do well. I would, also be very positive on the broader infra, and the capex side as well. Now, infra as a segment, had become virtually dead, I would say, in the last 10 years. But now we are seeing re-emergence of, airports companies, and ports companies, and in the broader infrastructure space there are a lot more that one can think about, and also on the manufacturing side. So whether you talk about like China Plus One, PLI, which I think is now driving the re-emergence of the manufacturing sector as well. So a whole bunch of ideas to look at in my view.
Okay, Sanjay, you want to weigh in on this sectors that you are looking at in the next year or so, and
so I would say,
are you also revisiting older ones, for example? That could also be an answer.
Yeah. In terms of the outlook, in terms of the sectors, one major change that I see is the way the technology is disrupting a lot of sectors. I'm not really referring to IT per se, but the way the technology is disrupting the auto sector, the banking, the BFSI, etc., and the greenification of energy. I think that's an emerging sector which we are really looking at it on a structural basis. In terms of some of the older sectors, and this is something that I keep talking to my analysts, that we need to be a little more open-ended in terms of the way we're looking at it. At any given point, we would, of course, will have an opinion on all the sectors that we like, etc. But you also need to constantly re-evaluate some of the older themes which are there. I think if you recollect, and I think this is something that Neelkant also spoke about, sometime in October last year, we had an energy deficit, and we'll probably have another year or two, we'll continue to have an energy deficiency in the country. And the reason why it actually happened is we'd stopped investing in thermal capacities. We believe that our renewables would be enough to support the new demand which is there. Given the fact that we are expected to grow very strongly in the coming time, to ensure that we don't derail our growth, the government realized that we needed to set up thermal capacities. If you recollect, in the last 4-5 years, there have been no thermal capacities. The moment there was a realization there's an energy deficiency, the government came up with a new thermal capacity plan for the next 7 to 8 years. And all of a sudden you have a sector which is actually woken up. So you have the utility companies doing well, you'll have the manufacturers and the distributors, etc. The entire value chain coming through, which is really tying up to maybe the engineering side and the services. So those are the sectors which are really emerging and coming out.
Right. Okay. So we're running short of time. Any questions from anyone for any of the panelists? Yes. So I'm going to collect questions. So go ahead. Yeah. Yeah, just keep talking. I think then it'll come on.
Hello. Yeah, Vikram here. So I have a questions to all the panelists. This is questions, or I would want a confirmation from the panelists. So I am firm believer that we are into an era where we can see a exponential growth in the equity market. To make this statement, there are a couple of things. Now, if I have to say, the investor base has grown almost 30% over the last 1 year. And if you see the larger picture, in the last 5 to 7 years, we have almost doubled there. And if we say the government is also doing good, Indian economy is also doing good, the GST collection is almost 150 plus. At the same time, though we are expensive compared to the emerging market, but if we see the earning growth wise, then we are relatively, fairly priced. And, overall, the government level, we have a fair, obviously, the stable government. At the same time, we have almost 80 to 90% capacity utilization. We are power consumption is also almost at an all-time high. And obviously, looking at the the growth, if we say in the next 3 or 4 years, if we continue to add this kind of investor base, obviously this will support our overall inflow to the equity market. So can I say that we are missing the larger pictures, and the picture will be, what we are projecting, it's bigger than that. That's my question.
Okay. Okay. Let me pick up 1 or 2 more questions. Yeah. Go ahead.
Hi, I have 2 set of questions, one for Mahesh. So generally we talk about equity market, and there is a lot of complacency in India with respect to the prospective or incremental return which we are expecting from equity market. Now, one of the fears which we have at times is that so we all talk about India becoming 4th biggest market, but we miss whom we replaced, and it was Hong Kong. And if you look at Hang Seng, it's almost at a level at which it was in 99. Somebody who would have invested $1 at that point of time after 24 years or 25 years is looking at 0 return. So what can lead to India becoming like that? So basically my question is about understanding the risks which we're not talking about here, because I think at some point we overmarket ourselves to ourselves, and that creates a sort of complacency, and which makes us feel a little scared about how things can pan out in the future. So that is question number 1. Second question is about what Mr. Sanjay mentioned about the correlation of earnings with nominal GDP growth. But if we go back in time, pre-COVID, our nominal GDP was consistently above the earnings. I'm looking at only Nifty 50 EPS. So if that correlation didn't prevail at that point of time, what gives us a confidence that going forward that correlation will prevail?
Okay, who wants to go first? Yeah, Mahesh?
Yeah, okay, so since you kind of
I
directly...
think the question, the first one was, anyway, you don't have to take it, but I was trying to understand. So were you saying that supply-led demand is alone not enough, supply of fresh investors and fresh funds into the market?
So I was making the point that we have the investor base
is growing, yeah. So and there's fresh supply. So okay. I'm not quoting any number here, but I would say, like, Nifty currently we are at 22. Okay, so I am seeing that next 5 years extraordinary growth. Got it. Okay. Yeah, you'll also. Okay, you'll answer that. Yeah, go ahead, Mahesh.
I will take the question raised by this gentleman, as to are we like over marketing ourselves, or in a way, like what are the risks?
Are we believing our own hype?
Yeah, are we believing in our own hype? I think, so I would, answer this question in 2 ways. One is, I think it's a very valid question. What I think is definitely going to be a key risk factor is our own expectations, because, as you rightly mentioned, we are marketing, ourselves, and this is something that we, as in, like when I say we, I'm talking about like, we as in Indians, haven't really done, in the past. And I think it probably also shows to some extent the growing level of confidence, in our own capabilities. And I would say it's well backed by what has been delivered also over the last 5 to 10 years. But your question is valid. I would say that the big risk factor is the complacency, because given where the markets are, the expectation levels are high. And I think what can be a big risk factor is the disappointment, on those expectations. So we clearly have to make sure that the earnings growth that the market is expecting, the world is expecting, the investors are expecting is actually delivered, because a small level of disappointment on earnings delivery can actually cause large corrections in the market. So that I think is clearly one big risk factor to keep in mind. But if you take that out, and you might say that this is a typical bull market talk that I'm giving, but I really see that from the fundamental sort of point of view, there are lots of factors which are supportive of growth surprising on the upside than on the downside, according to me. And you mentioned about some of the charts that were shown earlier, and I didn't see it, but I presume it referred to the Indian corporate sector debt to GDP ratio today is at an all-time low. We have seen a massive deleveraging at the economy level. See, over the last 10 years, many countries in the world took advantage of the very low interest rate environment to lever up materially. India was one of the very few countries which actually saw deleveraging. And in fact, if you look at the banking sector today, the tier 1 capital adequacy ratio is at the highest level that we have seen in the last several years. So banking sector seems like very solid, very strong. Corporate sector is under leveraged, and we are seeing some signs of uptake in the housing and the other sort of investment side, which is just the beginning of the risk appetite, I would say, in the broader economy, not the market, but the broader economy. So I would actually say that there are a lot of risk on the upside as well. And maybe I think this was something that one of the previous sort of person was asking, that can there be substantial returns and substantial growth from here on, and are we underestimating growth? There is a good chance that we are underestimating growth as well. I would agree with that thesis.
Okay, Sanjay?
So this is referring to your nominal GDP versus the growth in the corporate profit. What I was really referring to is in terms of the long-term trend. In the short term, you will have some kind of a dislocation happening, and typically these dislocations happen when structurally the economy is changing track. So if you realize that in the last 4 or 5 years, there's been a significant focus and change in the focus towards setting up manufacturing base, etc., in the country, and that's what led to a dislocation between the nominal GDP growth as well as corporate profit. The important question is, going forward, how are you looking at it? I mean, are we going to see any major structural changes, etc.? One positive aspect is what the Fortune 500 companies are following, what I call the ABC strategy, that is anything but China, which actually India can be a big beneficiary. We can keep debating whether we're going to get everything that China does. Even if we get a fraction of it, I think that can be a significant thing, significant upside that we should be looking at. And that's the actual agenda. If we're going to see a disruption in any of the policies that we've seen, whether it's in terms of PLI, defense offset, railways, CapEx, then we might see a dislocation. But my sense is, at least at this stage, the foundation has been laid out for your nominal GDP and the corporate profits to track effectively. Let me just take up that question on the mutual fund folio. See, if I remember correctly, there are 3.6 million unique folios in the mutual fund side, which is approximately 2% of the equity. And there are about 6% of the Indian population trading directly on the equity. And I'm not getting into the PAN card and the UPIs, etc., which is a much larger number. So if I have to look at it in terms of the potential of the mutual fund, I think we can easily see tripling of the mutual fund folios during my lifetime. And that can be a substantial opportunity per se for the mutual fund side.
So you're saying there are only 3.6 million unique investors in mutual funds?
Which is about 2% of the population.
Okay. And what would the figure have been, let's say, 2 or 3 years ago, pre-COVID?
So it would be about 1.5, 1.6%.
Okay, so it's more than doubled in just this period. Okay. Some more questions. Oh, sorry, Gautam, you want to weigh in? And then some more questions and then we close.
See, whether you under market or over market is a function of your time horizon. If your time horizon is 12 months, obviously you stand the risk of losing some money. But if your time horizon is 5 years, and if you believe that this 4.5 trillion economy or whatever, 3.6 is moving towards 7, 8 at some point of time, and generally, like we discussed, corporate earnings have always followed the markets have always followed the corporate earnings. Over a period of time, they've converged. If you believe that 8 trillion, 7 trillion economy number, and even if we average around 90 to 100% of the market cap and don't go into a bubble territory, there is still a lot of money to be made over a 5-year period. So I would still say with a lot of caution at my command that the best is still ahead as far as equities is concerned.
Okay. Any more questions? Yes. And then I'll come to you.
Yeah. This is for Mahesh and you can also. So see, when we heard Neelkant also, he spoke about the fact that, especially in the US, on the one side you see that the fiscal deficit numbers are high, their debt to GDP is increasing, and the point which he made was that if that is the case, you'll most probably will see a QE easing, because ultimately they have to go and buy debt on the one side, and that will be positive from the India point of view. So my point is that what really happening in India and the India savings and investment into the equities, I think is well taken by everybody. There's hardly disconnect in that sense. But when it comes to foreigners, who will ultimately will be another important source of capital if you really want to have that kind of a growth. On one side, you have this particular analogy that ultimately the money will flow, because ultimately they will have a QE and that flow will come to the emerging market and will be the beneficiary of that. On the other side, if that is going to be the case, then obviously there is a bigger global challenge for US and the entire savings, right? They are the biggest hedge fund manager in this entire ecosystem where entire money flows to a one place and then they reinvest into the rest of the world. In that sense, you do see any risk from that point of view that if de-dollarization or the dollar himself becomes a problematic case, how will you see? And I'm talking about say maybe 1 to 2 years, because it's not easy to just say what will happen in next 3 months and 6 months. But if US GDP is at 150% and they're having a 9% fiscal deficit number, do you really want to have dollar as your asset and then recirculate that money in dollar terms?
Got it. Okay. Yeah.
Yeah, hi. PSU valuation is justifying at current level?
Sorry, what valuation?
PSU.
PSU valuation.
Or it's a liquidity driven?
Okay, I'd love to answer that, but anyway. Mahesh?
Yeah, so if I take the first question first, so what you're referring to is, basically, some global problems, and you're basically, what you're talking about is, the US dollar, comes under some kind of a pressure or some kind of problem because of fiscal deficit and debt to GDP in the US, etc. No, I think so that kind of an environment, I mean, we have to evaluate to what degree that problem is. But if it were to be like of a very, very severe nature, and we are looking at something like some large, maybe some large sort of PE funds or some global funds are going past, or some banks having some huge issues, etc., then it's a different matter. Then we're talking about something like a global financial crisis kind of a situation. But if you're talking about a moderate weakening of the US dollar currency, which is what actually our base case is. So if you think that we are in an environment where the US dollar as a currency sort of weakens in a moderate way, I would say that's actually a positive for from the flows perspective for emerging markets in general, and India in particular. And if I were to just put some of the flows in perspective, see, last year in CY23, the Indian market saw inflows from foreigners, the net inflows to the tune of around $20 billion. That's actually a very small number according to me. We used to see this kind of inflow of $20 billion per year back in 2010, 11, 13, 14, etc. Since then, so over the last 10 to 15 years, the size of the Indian market has become almost like 3 times or 4 times. The GDP has grown to almost same level. It's not just that. If you look at the AUM of US based equity mutual funds or sort of various asset management, that has also grown 4 times. So the kind of flows that we've seen last year is actually, if you put in the context, is 1/4 of what it was back in 2010 to 2014 kind of a scenario. So I would actually not be surprised that the foreign net inflows this year in India double to 40 or maybe even triple to 60. That's not as high a number as one might think, because one has to put that number in the context of market caps, GDP, global AUMs, etc. And it's not a very large number. So yeah, so once again, I would say that in case of a global calamity, it's a different matter. But as things stand today, we're talking about like soft landing, etc. We can actually see much larger foreign flows this year than what we saw last year.
And it also goes back to the point you made about meetings in Davos, right, with a different kind of class of investors and so on.
See, the thing is, just to add on, over the last 10 years, a lot of global investors have taken very large positions, on China. And India, as I mentioned, was a market that could have been easily ignored, and people ignored it. But I think the size and scale of the markets have come to a level where I don't think it's a market that one can easily ignore, especially in an environment if the dollar is going to be weaker currency. That's the point.
PSU stocks, do you want to respond to that, Gautam?
Without getting into stock specifics, just 2 things. I mean, PSU index, there is something called as a BSE PSU index. It gave you negative returns over a 9-year period between 2012 to 2021. Okay? And earnings had remained stagnant, or maybe 5 to 6% lower, because you went through that period of dislocation in PSU banks' balance sheets. A lot of PSU banks reported losses. If you look at the numbers, 2018 was the peak of the banking losses actually. The total 11 financial companies in Nifty, they made a profit of just 45,000 crores in FY18. As we are about to close FY24, the same number has reached 2.5 trillion. And estimates on the street suggest, our own estimates suggest that we are approaching a mark of 3 trillion profit from just 11 financial companies which are present in Nifty. Just to get a perspective on that number, 5 years back, FY20, the total Nifty profit was 3.4 trillion. In 2025, just 11 companies will make 3 trillion profit. As far as PSU is concerned, 2021 to 23, because 24 is yet to close, 2021 to 23, the PSU profit pool tripled, right? It tripled after going nowhere for 9 years. And between 100 to 300, because it's tripled, out of the 200, 50% came only from PSU banks. Rest 30% came from metals and then everything else, utilities and defense, because they are PSU heavy sectors. So if you are evaluating PSU from a lens of where they were 10 years back, obviously the multiples have gone up. There is a lot of euphoria in some segments of PSU pockets. Anything which has any connotation with a defense, railways, those stocks have flown 5-6 times in the last 1 year. Obviously, from where you started, the valuations look much, much richer. But who's to say that this valuation cannot sustain? If you have a period of 5 to 10 years of policy stability, policy momentum continues, and investments in infra, manufacturing, capex, PLI, export continues. See, one thing which has changed, in my view, as far as PSU banking is concerned, the quality of underwriting has improved dramatically thanks to a lot of reforms which have happened. Whether it is IBC, the GST, a lot of promoters have seen their assets getting squeezed because of IBC. So today when a promoter walks into a bank branch or a banking corporate branch to take a loan, he thinks 10 times before taking that loan. And obviously banks have also become wiser from the earlier experience, which is why today, as we speak, there are 5 to 6 PSU banks which have already reported a ROE last year, a year before that of 14 to 15%. Expectations are some of them will report 17, 18% ROEs, right? So taking a view on PSU as a basket is very difficult. You have to look at, bottoms up, sector by sector, stock by stock. But yes, I do accept that the valuations over the last 2 years have compounded crazily. As an asset class, this has not been in favor. In fact, our founder publishes a study, the wealth creation study. There is one slide every year in that, which just delineates the wealth destroyed by PSUs. Right? There is a nice chart there of last 25 years. In the last 2 years, that chart has turned around. And PSU as an asset class obviously come into fancy. There are a lot of theme-based funds which have got launched in the domestic asset management industry. So yeah, it depends on what your view as far as policy is concerned, because they are obviously dominated by sectors where government plays a very, very pivotal role. So if you have a policy stability and policy momentum maintained, but we all have learned that market sometimes can stay irrational longer than we can stay solvent. So that can play out in PSU also.
Okay. And half our sponsor today is a PSU, so we should be kind to them. Not to forget. The dinner that you will have will be half paid for. Anyway, so we've run out of time. So I'm going to quickly, I was asked by our organizers to ask some rapid fire questions. This won't obviously be a, Karan Johar kind of thing, but let me try and bring it to this thing. So let me start with you, Mahesh. You can, if you skip that question, I'll ask you another one, okay? So you'll have to...
Sanjay?
Okay, I'll start with Sanjay, since he is the host. Sensex on April 1 and Sensex on June 1, 2024. Or Nifty, choose.
So tracking the corporate earnings growth.
Okay. No, I'll ask you a different question. So one thing, Gautam, that you got right, that you feel, it could be a stock or a sector, that you will want to tell your grandchildren about.
Stock or a sector? Titan.
Okay.
With all disclosures in place.
Okay. Mahesh, same question.
So we have a formal target for Nifty, not for Sensex, for December 24, which is 24,000.
Okay.
So
that takes care of April and June. Okay. So one stock that you will, or sector that you will want to tell your grandchildren about.
So stock I cannot talk about because of compliance reasons.
Sure.
For grandchildren, that's a big one. Because the big theme that we are talking about is the capex, which is more cyclical. So that's not.
So you're giving me a very long answer. I want one answer.
I think that's a very tough one. To be honest with you.
Okay. So let me ask the other one then. What's the mistake that you made in picking a stock or sector which you will not tell your grandchildren about?
So yeah, that I can tell. So the one thing that I got completely wrong over the last 10 years is this whole rise of FMCG and consumer multiples, which I got completely wrong because I was an analyst myself. So that's now the mistake that I'm now correcting, by actually saying that this, those multiples should now come down and, the ones on the capex side should go up equally strongly.
Okay, let me give both of you the opportunity to answer that. Sanjay?
So I think not reading the balance sheet and investing was the biggest mistake, and that's something that we've corrected.
Okay. Gautam, last word.
Lots of mistakes. We can spend the whole evening discussing that, but the foremost that comes to my mind is not having spent enough time understanding commodity cycles.
Commodity cycles. Yeah. Okay. Okay, we've run out of time completely. Thank you so much. I'd love to sum up, but I think we've got a fair degree of, or a fair idea of what we've spoken about. I think the overall, obviously the outlook is bright. We seem to be now going and looking ahead of maybe June or July for the year. We've clearly, it's clear that there is a capex cycle that is about to start. The capex cycle itself will be a growth trigger. I think we've also become smart about the way we look at sectors which will clearly grow versus sectors that may not, though they will continue to do well. We've already talked about examples in consumers. We've also looked at what the flows are looking like, which is very positive. The most important, one of the more important points is obviously the gap between financial sector assets devoted to equities versus the opportunity that there is. And I think that there is a huge opportunity and runway still to go. On that note, thank you very much.
Thank you so much. Well, actually, that was very interesting, but also you ended up with a fun rapid fire to lighten up. But yes, I would now request Mr. Suresh Soni, CEO Baroda BNP Paribas, to please come on stage and extend a token of gratitude for all our esteemed panelists and our moderator here. Let's give them once again a huge round of applause. And meanwhile, I hope that you all are still tweeting and talking about the sessions that are happening and are using our hashtag, that is BBNPP Connection, and on all the social media platforms that you use. And please do not go anywhere. We have another panel discussion right after this. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.